For most filmmakers, videographers, people that own a video production company, typically taxes are going to be the biggest expense they're going to have. And I just had a long end of the year conversations with my CPA. I typically have these conversations in December to make sure I'm doing everything I can at the end of the year to basically help me with my taxes. And I wanted to share some of the things that he shared with me. This is, again, not going to be financial advice specific to you because this is my CPA giving advice to me, but I thought by sharing it, you could have these type of conversation with an accountant yourself. And I typically recommend you hire a CPA, a certified public accountant, so they could help you with your situation. Hopefully, these 7 tips that I'm going to share here that I learned from this conversation, I've done this again with my CPA for about a decade or so, and they're always useful. They always save me money on taxes. And at the end, I'll also explain my business structure that saves me tens of thousands a year that I notice a lot of people are very confused about or don't even know about it. So I'll share that. That's not a specific tax tip. It's more a thing I do with a business structure that in my case saves me a lot of money. Okay, so the first thing is, let's say you have a profitable year. At the end of the year, you could make some investments towards growing your business the following year. Okay, this is again something I've done for about a decade. I did it before as a freelancer too. But most of the time, this is investing in new camera equipment, for example, or lenses or lighting or office furniture. This is pretty much the easiest one. Most of us already are utilizing this to some extent. But I do other things on top of this, okay? So it's not just equipment I typically buy in December. It's equipment that I think is gonna help me make money the next year. I did make a dedicated video actually talking about how I make these decisions. So I don't just buy a $10,000 camera because then I think, well, I have $10,000 write-off. I actually really think about it, but this is one of the reasons why I buy things in December. If you really break it down, a $10,000 camera, for example, if you have a $10,000 profit, right, you will have to pay taxes on that $10,000 profit. Typically, that is going to be federal, state. If you're in the US, those are the 2 taxes you'll pay. And you sometimes pay self-employment tax that could be up to 15% of your income as well. So when I buy a $10,000 camera, and if I'm paying 30-40% in tax, I think of that as a big, basically, coupon towards that. But again, watch that other video if you're choosing equipment as a way to get a deduction at the end of the year. Another thing I do that is around this type of an expense is sometimes I prepay things. Like I'll prepay for Adobe for a whole year for my team, right? I'll make sure I pay that in December, then I take it as a deduction that year. I also do this with educational expenses. So I'll buy courses at the end of the year. Typically, really I invest in a lot of marketing courses for myself to make sure I'm up to date on all things marketing. So that's something, again, I buy because I know if I buy it, again, based on my accountant's input, I could deduct it as a business expense and I could utilize it to grow my business the following year. If I've also hired any vendors, any freelancers throughout the year, especially if I've hired them in December and maybe I don't have to pay them for 30 days, I still make sure I pay them in December so I could take that deduction in that tax year. And before we go to the next point, I just want to say, make sure you could justify these business expenses and they're expenses that could grow your business, not just save you on taxes. I much rather pay a tax than buy a camera that I won't ever use, right? This used to happen to me all the time, and I got a whole bunch of gear I never used because I thought as long as I keep investing in my business by buying equipment, I will grow, and that's not the case. A lot of the investment should go in other things like education or marketing, not just camera and lighting and lens equipment. The next thing I do is I pay out bonuses. So this is only relevant if you have employees or you have freelancers that you use pretty frequently. But again, that's an expense that you're paying out as a bonus, as a salary bonus to your employees. It's a great motivator. It's something I do typically at the end of the year in December, and it really encourages my employees at the end of the year. So it's something that's personalized, again, in my case, but I find it very valuable and it's a good business deduction. Now, the next thing is my deduction for retirement. So when I first started out, I used a traditional IRA. So there's 2 different kinds of IRAs. One is a Roth IRA. The other one is a traditional IRA. The traditional IRA right now has a limit of $6,500. This typically changes based on inflation year to year. Now, I write this $6,500 off as an expense when it's a traditional IRA. It's basically a write-off. It's not a business write-off, but you take it as a personal deduction. In the Roth IRA, you can't do that, but the money basically grows tax-free and you could take it out tax-free. So usually if you're making a certain amount of money, the Roth IRA actually makes more sense. I've always had the traditional, which gave me that tax benefit right now, which was I contributed the maximum, again, $6,500 this year, and that was a write-off on my personal tax return. Now, once my business grew, I looked at other opportunities for retirement expenses and retirement, and there's two other options. One is called Solo 401k, and the other one is called SEP IRA, SEP. Now, these have a much higher limit. For example, the Solo 401k this year has a combined limit of $61,000. In 1 year, that could be a $61,000 tax deduction. It's typically a portion of it comes from your salary, to $20,500. The rest of it, the company matches up to $61,000. Again, there's some complicated math that's involved here, so you got to talk to your accountant and see even if you qualify. But imagine taking a $61,000 deduction this year. Is $61,000 you contribute to your own retirement that you could take out when you retire. Next is the home office deduction, which they really simplified this much more in the last few years, but definitely look into that. But you basically take down a portion of your house that is solely dedicated to your business. Like this space that I'm using, this is actually in my house and it's solely dedicated to my business, right? So I could write this off as an expense. There's nothing else that happens here but filming videos and working. So you could basically take this on based on the square footage and the usage, and this includes utility expenses, or you use the simplified version of it that they recently rolled out. That just makes it a lot easier to take this expense. And the next one I look at is my auto-related expenses. And this could be, again, in the form of the standard mileage that you could take, or you could basically keep track of your mileage and do it that way. But as a freelancer, or if you run your own company, this is a huge deduction. So talk to your accountant about this specific thing related to your auto expenses. There's another personal deduction here. It's called a HSA, or health savings account. And I learned about this only a few years ago. But basically, if you set up a high deductible healthcare plan, and again, not everyone's going to qualify for this, you could contribute this year up to $3,600, and this becomes a tax deduction on your personal return. And this also grows tax-free, and you could use this pool of money for medical expenses. I also invest what's in my HSA account as well, on top of basically letting it grow tax-free. By contributing the maximum and investing that money, it even grows more. So I don't have to touch this unless I have a medical expense. But when I have a medical expense, I could use this health savings account to pay for things. Next, I look at making a donation at the end of the year. This could be in the form of cash. This could be in the form of donating used equipment, donating office supplies that I'm not really utilizing. So I make sure I keep track of this, and I make sure I take this deduction as well. Again, this is a charitable contribution, but this is a really good expense. So if you have things laying around that have some value, you do need to talk to your accountant about taking that donation as your deduction. And finally, the structure of the business, what I mentioned in the beginning of the video, this is really kind of complex if you've never heard of this before, but I'll try to simplify it the best as I can. But most people are basically set up in three different types of structures. They're sole prop, meaning they don't have any type of business structure. They're just working on their own name. A lot of freelancers are set up this way. Most of the freelancers I hire are set up this way. There are people that set up an LLC. I have a company that's formed as an LLC. And then there is a lot of people that are set up as an S corporation. So those are the three most popular type of entities. Some partnerships roll into the LLC type as well. But here's the big tax savings that I learned far too late, okay? If you're a sole prop, if you're a freelancer, if you don't have a business entity, let's say you made $100,000 in profit after all the expenses that we talked about outside of your personal expenses, all your business deduction left you $100,000. I'm just using a round number here. And then from that $100,000, what ends up happening is that's profit. So now you have to pay tax on that $100,000 profit. And I'm using the United States where I'm at as an example, but you pay federal tax depending on the tax bracket you're in. I believe that's 22 or 24% federal tax bracket. Then you pay state tax. I'm in Illinois, so that's 5%. In California, it could be higher or it could be a bracket as well. Mine is a flat 5%. But then because you're self-employed, you don't have a business, you also paid a self-employment tax. This is 15%. Okay, so on that $100,000, that's $15,000. Now this is where something like an S corporation comes into play. In an S corporation, it doesn't quite work like that. You still pay federal, you still pay state on that $100,000, right? There's no way to avoid that unless you invest more into your business and take those type of deductions. But what ends up happening in an S corp, this also doesn't happen in an LLC, by the way. This only happens in the S corp. You could basically give yourself a salary on that $100,000 and take the rest as a bonus. So to simplify it, we have $100,000 in profit. If we gave ourselves a salary of $50,000, the other $50,000 is basically called distribution, okay? Now that distribution is not subject to that 15% I just said. That Social Security and Medicare that adds up to that 15% self-employment tax. In an S corp, it's only subject on the $50,000 salary. The bonus, you save that 15% on the $50,000. Now this adds up, right? Let's say you made $200,000, $300,000, right? As you make more money, it typically, I think it's like around the $80,000, $90,000 mark where this actually makes sense. But again, talk to a CPA about this. This is a huge tax savings. Now, all you have to do is give yourself what's called a reasonable salary. So you can't give yourself a $10,000 salary on a $100,000 profit. It doesn't work like that. But let's say $100,000, $50,000 was salary, $50,000 was profit. This $50,000 is not subject to 15% self-employment tax. Social Security and Medicare is not going to come out of this bucket. Only federal, only state, which is basically any income you make, you're going to have to pay that anyway. So that's a huge savings that I had no idea that I could utilize till I became an S corp. If you form an LLC, by the way, and you already have that set up, there's this thing called an S corp election. Basically, you file a piece of paper and your LLC gets taxed as an S corp using, again, this benefit that only S corps could utilize, that LLC and sole prop people that don't have a company and work under their name cannot utilize. So if you do anything from this video, talk to an accountant about this specific business structure to see if it makes sense for you. And hopefully one of the 7 other things I mentioned could save you some money at the end of the year. Thanks so much for watching. I'll see you on the next video.